You've been trading crypto, staking, maybe even flipping some NFTs. Then tax season rolls around and suddenly you're staring at a pile of transactions, not sure what is taxable, what is deductible, or if you're about to owe way more than expected. If that sounds familiar, you're not alone. We are breaking down exactly how crypto is taxed in Canada, common mistakes that cost people money, and how you can keep more of what you have earned, all without stress. Big thanks to Block3 Finance for sponsoring this episode, trusted by over 1,000 crypto investors worldwide to navigate tax season. Let's dive in. So how does the Canada Revenue Agency, CRA, see your crypto? Unlike traditional money, crypto is classified as property, not currency in Canada. This means that every time you sell, trade, or use crypto, you're triggering a taxable event. There are two ways the CRA can tax your crypto. First one is capital gains tax if you're buying and holding crypto as an investment and later sell it for a profit. Only 50% of your gains are taxable at your marginal tax rate. The next one is business income tax. If the CRA considers you to be trading frequently or earning crypto as part of business, then 100% of your profits are taxed as income instead of just 50%. So what counts as a taxable event? Here's a simple breakdown. Selling crypto for Canadian dollars or any fiat currency. Trading one cryptocurrency for another, yes, even swapping Bitcoin for Ethereum counts. Spending crypto to buy goods or services. Earning crypto through staking, mining, yield farming, or getting paid in crypto. What isn't a taxable event? Simply holding crypto in your wallet even if the value skyrockets. Unrealized gains aren't taxed in Canada, but once you sell or trade, the CRA wants its cut. Now that you know when your crypto is taxed, how do you track and report it? This is where things can get messy because exchanges don't always provide tax forms, and if you've been using multiple platforms, DeFi or self-custody wallets, the CRA expects you to track everything yourself. Here's what you will need to keep track of. Dates of each transaction, what crypto was involved, the price in Canadian dollars at the time of transaction, any transaction fees paid. You can use crypto tax software like coin tracking, Coinly, or CoinLedger, or manually track everything in a spreadsheet. Here's a pro tip: keeping records now saves you from a tax nightmare later, especially if you ever get audited. Nobody wants to pay more tax than they have to, right? So let's talk about ways to minimize your tax liability legally. Tax loss harvesting. Tax loss harvesting. If you had losing trades, you can offset your capital gains by selling at a loss before the end of the year. Losses can also be carried forward indefinitely or backward for 3 years to offset past gains. Deducting expenses. If crypto is part of your business like mining or professional trading, you can deduct costs like electricity, trading fees, software, and hardware. Holding long-term. Casual investors who hold their crypto and only sell occasionally will usually qualify for the lower capital gains tax rate instead of full business income tax. Structuring through a corporation. In some cases, setting up a corporation can provide tax benefits, but this should be done with professional advice. And of course, working with a crypto-savvy accountant can save you money and help you stay compliant. Before we wrap up, let's bust some common crypto tax myths that could get you in trouble with the CRA. Myth number 1, if I don't cash out the fiat, I don't owe taxes. Reality is that trading crypto for another crypto like BTC to Ethereum is still a taxable event. Myth number 2, I don't need to report my DeFi or staking rewards. The CRA considers staking, mining, and yield farming rewards taxable income at the time you receive them. Our next video will cover DeFi staking and mining, so stay tuned for that. Myth number 3, the CRA won't find out if I don't report my crypto because crypto is untraceable. The reality is that the CRA is cracking down on unreported crypto income and working with exchanges. And crypto transactions are fully traceable on the blockchain. If you get audited and haven't reported, the CRA can track your activity and could face penalties and interest. Bottom line, be proactive, keep records, and stay compliant. Before we go, let's talk about deadlines because missing them can cost you. Canadian tax deadline, April 30th for individuals, June 15th for self-employed, and 90 days after year-end for corporations. Penalties for not filing. Late fillers can face a 5% penalty plus 1% per month of what you owe. If the CRA audits you, interest and penalties can pile up fast. So don't wait until the last minute, start organizing your crypto tax records now. So that's your Crypto Tax 101 guide, sponsored by Block3. If you have any questions or require further guidance, please contact Block3 Finance at inquiry@block3finance.com for a free initial consultation appointment. Block3 Finance have worked with over 1,000 clients in the crypto space globally, and they have over 31 accountants ready to help you navigate your accounting or tax matters. Thanks for watching, and we'll see you in the next video.